If you had to pick one phrase at the center of the American dream, it would probably be home ownership. The wide picket fence, it instantly evokes the image of having made it. But the reality today is that owning a home is out of reach for most Americans. Rising home prices, increasing unaffordability, and stagnant wages have meant that many would-be buyers are forced to remain in the rental market. And that's been a huge windfall for rental landlords. But there's a fast-growing and highly controversial offering that wants to bridge the gap. It's called rent-to-own. Let's break it down. Simply put, rent-to-own refers to giving renters the options to purchase the property they're renting for a fixed price, provided they come up with the money in a pre-agreed upon period, let's say typically between 3 to 5 years. The sale price is locked in at the start of the lease, and some companies offer renters a discount for buying the homes early. Renters typically shoulder the cost of maintenance and upgrades. It's billed as a path to home ownership for those shut out of the mortgage market, and it's something VC firms have been all over recently. Take Divvy, for example, which is a startup that raised $200 million over the summer at a $2 billion valuation from the likes of Andreessen Horowitz and Tiger Global. This is just 6 months after the company raised money at a valuation 1/4 of that, which gives you a sense of how much investors are thinking about this sector and what Divvy's growth has been. Then there's Landis, which raised $165 million last year from Sequoia, as well as Will Smith and Jay-Z. But by far the biggest player in the space is Home Partners of America, which now owns about 17,000 homes across the US. It's owned today by Blackstone, which paid $6 billion for it in the summer, but it was the brainchild of a guy called Lou Ranieri. That Lou Ranieri, the inventor of the mortgage-backed security. You might remember that as the instrument whose abuse led to the collapse of the housing market in 2008. For many, rent-to-own brings up memories of those same dark days. The sector has seen high eviction rates, and many tenants have been unable to come up with the cash to buy their homes, leaving them in the position of having paid inflated rents for the time they occupied the property. Home Partners of America told the FT that about 1/5 of its tenants ended up buying their homes. The publication reported that many were paying above market rents for the properties, sometimes up to 10% more than the market rent. Adina Heffitz, who's the CEO of Divvy, she described it a little bit differently. She talked about Divvy, her service, as a savings mechanism for clients. Divvy tenants pay above market rents, and if they're unable or unwilling to buy at the agreed upon time, Divvy returns the extra money minus a surrender fee of about 2% of the original purchase price. Clearly, Wall Street and Silicon Valley see huge riches in store for the rent-to-own market. But will it work out as well for the aspiring homeowners? Or will their American dreams turn into the next housing nightmare? Let us know your thoughts in the comments below, and be sure to follow The Real Deal on YouTube and Instagram for more Paydirt breakdowns.